how to bet on inflation the hard way. There's an easy way to bet on inflation and a hard way to bet on inflation. Like with many things in life, the harder something is, often the more lucrative it is. And that is certainly the case with this strategy for betting on inflation. By the time you're watching this video, you'll be aware of a unique strategy to not just hedge against inflation, but to profit off of it. So, lovingly, tenderly, gently, smash that like button for the YouTube algorithm, and let's get started. You're watching Finance Squared, and I'm your host, Derek West. And on this channel, we love to talk about all things personal finance. And certainly, hedging and even profiting off of inflation is something that we love talking about. If those sorts of things interest you, do yourself a favor and subscribe to this channel with post notifications turned on so you can join in on the discussion the second videos like this drop. So many places to start and so little time. Let's start with inflation, what it is, why people are fearing it at this point in time, and the different strategies to mitigate it. With that basic knowledge in mind, you can certainly appreciate the strategies to not just mitigate inflation's ravaging effects, but to profit off of it. Inflation, everyone's favorite economic phenomenon. Inflation is when money is chasing the same amount of goods. I mean goods and services when I say goods, that is. And in a healthy economy, a lot of people theorize that inflation is a good thing and not necessarily a bad thing. It means that more people are gaining access to the currency as the economy continues to grow. But the idea is to keep the inflation rate at a pretty low level. Most economists say less than 2% is ideal to ensure that the value of money doesn't decrease too quickly and get out of whack with the amount of goods that the economy is capable of currently producing. The reason that is now being feared in some circles and targeted in others is that inflation in the US is on the rise. Prices of commodities are starting to increase and prices of everyday items are as well. Not to mention the fact that both the head of the US Treasury, Janet Yellen, and the head of the US Federal Reserve, Jerome Powell, are both predicting that inflation will increase in the coming years. And that takes us to a discussion of the Consumer Price Index. You see, the Consumer Price Index is a metric used by economists and YouTube channel hosts to get a gauge on how prices on a specific basket of goods and services changes over time. It is a widely used metric of inflation, and some say the most widely used, which is why inflation fears were kicked off in April when the Consumer Price Index for all urban consumers rose 0.8% and all food items 0.9% on a seasonally adjusted basis. And over the last 12 months, that same index rose 4.2%, and for food and energy items 3.0%, not seasonally adjusted. So inflation is really starting to heat up. But the thing is, it's been about 40 years since the last real bout of inflation in the US. And this latest bout is probably due to the spending that has been taking place since the beginning of the pandemic to help people, small businesses, and others deal with the consequences of the virus that shall remain nameless. People fear that this level of inflation might get worse, much worse, back to 70s levels, and maybe even more, approaching hyperinflationary levels due to pent-up demand in the economy now that we are coming out of the worst of the lockdowns. This high level of inflation could force the Federal Reserve to raise interest rates much faster than they would have hoped, putting cold water on a heating up economy, just as it is needed to help further pull us all out of the lockdown doldrums. Even if inflation only stays at around 3%, many are speculating that the Fed would be willing to let it ride at around that level to help the economy mend up and get back to pre-pandemic levels of roughly 3.5% unemployment. And that's the reason that people are fearing inflation. There are a couple of ways that people are looking to mitigate inflation risks. And let's start off with bonds. Specifically, avoiding long-term bonds, and really bonds in general. If you think about it, bonds are really the equivalent to loans. It is one of the ways you can get on the opposite side of interest rate payment scenarios. But because most bonds receive a fixed coupon rate that doesn't increase, if you buy a 30-year bond that pays a 4% interest rate and then inflation skyrockets to 12%, you'll be losing 8% a year, assuming that inflation rate sticks. But there are some types of bonds that can actually help to hedge against inflation, such as Treasury Inflation Protected Securities, or TIPS for short. When the Consumer Price Index rises, so does the value of a TIPS investment. Not only does the base value increase, but since the interest paid is based on that value, the amount of interest payments rises with the base value increase. So those are bonds. Let's talk about cash flow investments. If you invest in assets that cash flow, if price increases, you are in the driver's seat to get more cash right along with it. Think about it. If the price of food increases, if you own a franchise or are invested in a chain store like McDonald's, then McDonald's can increase their price, which will negate the effect of inflation on your investment portfolio. If you own or invested in real estate, then you can increase the rents, assuming demand for real estate remains the same. And here's a pro tip. Be very cautious of non-housing commercial real estate, like malls and office parks. That's probably a subject for another video, so like and subscribe. And then there are commodities. Commodities can be a great way to mitigate the effects of inflation. If you own a farm that produces commodities like wheat or corn, an oil field that pumps out crude, a wind or solar farm that pumps out electricity, or a mine that pumps out gold, silver, or copper, you probably are not going to need to worry that much about inflation. That's because people are going to be paying for those goods with whatever they have available, mostly because they're crucial for surviving and thriving in today's world. You don't even have to own the farm, mine, or oil field. You can invest in those commodities via the commodities markets, for ease of investment purposes. And then there's cryptocurrency. This strategy is kind of new and somewhat risky. You see, in my opinion, most cryptocurrencies are just vaporware, and the ones that aren't that efficient, and they're extremely expensive, and they're mostly being traded back and forth between hyper enthusiasts. But that doesn't mean that they don't have a future, or that they can't be used today to help mitigate the effects of inflation. And since they are currencies, they can be used to purchase products just like anything else. And with more and more retail outlets accepting crypto as a form of payment, it's becoming more and more commonplace. But you don't have to settle for just surviving inflationary pressure. You can thrive in an inflationary environment and even profit. Yes, it's true. The question is how? Well, let's take a look at 3 different ways. We talked a little bit earlier about bonds and how a lot of bonds should be avoided, and that some types of bonds, such as TIPS, can be used to hedge against inflation. Well, there's another type of bond out there, a high yield bond, affectionately referred to as a junk bond, that can provide a bit of an aggressive posture against inflation, with a slightly higher risk profile. So junk bonds are bonds that carry a higher risk of default than most bonds typically issued by corporations and governments. Why are they riskier? Well, the bond, which is a debt or a loan that is promised to be repaid, is issued by a, let's say, less than reputable institution or individual, typically by companies that are struggling financially. And this financial risk is typically rewarded by a higher yield to investors. And high yield bonds have been known to gain in value when inflation rises. Now, the risk of such bonds doesn't go away, but the rewards just become that much sweeter. And then there's loan and debt obligations. Now, leveraged loans are floating rate instruments, meaning that banks and other lenders can raise the interest rates so that the return on investments keeps pace with inflation. Wait a second, that is starting to sound familiar. Oh wait, yeah. Mortgage-backed securities and other collateralized debt obligations are effectively packages of these loans put together for investors. And usually for larger institutional investors, the kind that are too big to fail. But individual retail investors can get in on the action, as there are likely ETFs and index funds or mutual funds that specialize in these income-producing assets. Which takes us to someone who made their name by discovering the risk in the last collateralized debt obligation scheme. I, of course, am talking about Michael Burry of Big Short fame, who once famously predicted the collapse of the US housing market in the mid-2000s, and profited from it, unlike most investors at the time. Incidentally, he also helped to kick off the GameStop short squeeze by investing in GameStop and forcing the folks running the company to make changes. In addition to that, he predicted that post-pandemic inflation would be a consequence of the large spending outlays that were passed to heal the country from virus-related lockdowns. And he was right again. What do you know? He's making another prediction that the United States, thanks to all the high spending and big budgets, will experience Weimar Republic-style hyperinflation for one of the few times in its history. His recently released 13F statement for the second quarter, released around the May 15th time frame, gives us an insight into how he's looking to profit from a possible high inflationary environment. Let's take a direct look at some of his outlays. He bet 12.7% of his firm's current holdings on a put option for 20-plus year Treasury bond ETFs. He did something similar for ProShares Trust Ultra Short Limit 20-plus year ETF, which represented about 4.1% of his firm's holdings. This time it was a call option. The thinking behind this is that rising inflation over the mid to long term will lead to the need to increase interest rates, thus making those same 20-plus year bonds less attractive overall. And just a real quick primer on put options in case all this is like speaking Greek to you. A put option gives the holder of the option the right, but not the obligation, to sell a specified amount of an underlying security at a specified price within a specified time frame. Typically, put options increase in value as the underlying asset falls in price and as volatility of the underlying asset increases and as interest rates decline. They can also lose value as the underlying asset increases in price, as volatility of the underlying asset price decreases, or as interest rates rise and the time to expiration nears. So Michael Burry is betting that sometime during the life of his put options that the Federal Reserve will be forced to raise interest rates, making those bond ETFs, which are just baskets of bonds, similar to stock ETFs, less attractive overall, and thus his shareholders much richer overall. And put options are really part of a larger world of exotic investment instruments that can be used as both ways to hedge against downside risks and to bet big If you'd like to see a video from this channel on such exotic instruments, be sure to leave a comment down below expressing your desires. And to make sure you don't miss that video when it drops, be sure to subscribe to this channel and turn on post notifications. And remember, a goal without a plan is a wish, and a goal with a plan and no action is a wish list. Thanks for watching Finance Squared. Drop a comment with what your thoughts are on these inflation avoiding strategies, and I'll catch you next time. Peace.